Hello traders, welcome back to the channel. Today we are diving into an interesting strategy that I recently employed on January 12th on Tesla. And I want to share it with you. In this video, we'll explore why I went long on a downtrending stock based on the daily chart. I like to call this strategy the gap down extended stock strategy. So let's break it down step by step. Now, the first thing that caught my attention was the downtrend on the daily chart. You can clearly see that the stock moved around 265 all the way to the 230 until Thursday. And I observed at least 3 consecutive days of the stock moving downward. But here is the kicker. I look for the stock that were extended from both the 5 and the 9 moving averages on the daily chart. Now, if you look at this chart closely, on the Thursday, we already have a 3 red days in a row. The stock price is away from the 5 and the 9 moving averages. I paid also close attention to the opening and closing positions related to the pre-market low. It is crucial that the stock opens and closes in proximity to the pre-market low, indicating a potential opportunity. After the market opens, the first minute is crucial in the strategy. I waited for the first minute candle to open green. To add an extra layer of confidence, I looked for the pre-market consolidation. If the stock had some consolidation before the market opened, that was an added advantage to me. So let's look at the pre-market chart on the 30-minute candle. And if you look at the 30 minutes chart, you can clearly see that from around 6 o'clock to before the market open, the stock is in consolidation, very close to the moving averages, and the stock is not making the new low, but at the same time it is consolidating very tight range. And that's what we're looking for if we wanted to see a reversal trend. Now the exciting part comes in the profit target. Identifying potential profit targets, any previous levels that look where the stock bounced off could be a potential profit target. It's all about finding those key levels to play as your profit targets. Let me show you some of them here on my chart. Now, if you pay the close attention to the November, we can see that there is a nice consolidation of a couple of days, and then there is a gap up day in the November as well. So now if you go back, look at it in the previous day on Thursday, the same levels was breakdown, and then we have a previous day low touched on the 225 level as well. So we can easily target that this is going to be our profit target, but is always going to be a target, so we're never going to expect the same. But this is very likely that the stock may reach back to that level and the retest this, and that's exactly happened on Friday. In conclusion, I would say that the gap down exit stock strategy is all about timing, key indicators, and being strategic in identifying potential profit targets. Remember, every trade involves risk, so make sure you do your own research and consider your risk tolerance before implementing any strategy. If you find this video helpful, don't forget to hit the like button, subscribe for more trading strategies, and let me know in the comments if you have tried this approach or if you have any questions. Happy trading, and I will see you in the next video. Thank you.